Coming up next, we have a very interesting panel discussion on how to identify the value of token. And we will, before I introduce the speakers, please allow me to introduce the interaction app that we're using for this conference. So I do understand a lot of you might wish to raise questions to the speakers on stage. So if you can find the QR code on your agenda on the bottom right of the paper, you can scan it with your WeChat or iPhone camera or other apps. And once you scan the code, you will be entering an interface. And then please choose join discussion. And then once you log in, you'll be able to send questions to the speakers. And during the last 5 minutes for each panel discussion, we will, the moderator will be asking questions, the most likes or the most asked questions from the app. If you don't have any questions, you always feel free to like questions so that your favorite questions will get asked. All right, so let me introduce the panel speakers for our next panel. Lucille Hu from FBG Capital. Mr. Scott Robinson from Plug and Play FinTech, Mr. Paul Veredictaki from Pantera Capital, and Mr. Zhu Xiaohan Zhu from ZMT Capital. And this panel will be moderated by Mr. Keith Tier from Accelerated Digital Ventures. Welcome.
Hey everybody. That was a really pathetic clap. Just want to say that. You're probably all tired, right? So we're going to wake you up. Let's start with a poll. Hands up if you lost money buying tokens. Lost money. Hand up if you made money. Actually, it's pretty even. Hands up if you never invested in buying tokens. Quite a few. Okay, so we're going to educate this audience. Do you guys want to quickly introduce yourself, like 30 seconds each, just so we don't take all the time? Why don't we start with, I'm going to say the name, Xiao Hu. Xiaohan.
Yeah. So hi everyone, my name is Xiaohan. So I'm the partner for ZMT Capital. So we actually invested as a traditional VC fund starting in 2016. At that time, one of our major focuses was fintech. So we started getting invested into quite a few blockchain companies. And in 2017, a lot of these blockchain companies started ICOs. And that's how we get into cryptocurrency and ICO space. And things have been changing really fast since then. And we invested in a couple of pretty interesting projects and had pretty good returns on these projects as well. And also learned a lot during the process and also made a lot of friends with the people in the ecosystem. So it will be great to share our thoughts in this panel discussion.
Hi, my name is Paul and I'm with Pantera Capital. And Pantera Capital was started in 2012 by Dan Moorhead, who used to be at Tiger Management, one of the world's largest hedge funds. So Pantera has been investing in crypto since then and has been focused exclusively on that. So we have 4 different strategies. We invest in Bitcoin, which is our earliest fund. We also have a venture capital fund. We also have an ICO fund that invests in just pre-sales. And then we also have a quant fund that uses data to algorithmically trade cryptocurrencies on the secondary markets. Manage anywhere from $600 to $800 million. And I've been in the space since early 2014. Really got excited about blockchain after reading some articles on blockchain and also reading the white paper. So I've been doing this for about 4 years now, focused on both venture and ICOs.
Good afternoon, I'm Scott Robinson. I sit on the board at Plug and Play Tech Center, a global startup accelerator and investor. In 2012, I ran across a couple articles in the white paper of Bitcoin and began showing up at the local Silicon Valley Bitcoin meetup that Roger Ver ran. So there was about 15 of us, and from there, when Roger left the country, I took it over, launched a small Bitcoin accelerator program. Paul was a key help alongside Pantera, and we've done about 20 investments in the space. So companies that you would know include Civic, Stellar, some new ones like Nuco and Block Daemon, Factum, etc. But Plug and Play has been investing for the past 20 years. Companies that you might know from that side of the world is PayPal, Lenny Club, and a few hundred more.
Hi, my name is Lucille Hu. I'm with a fund called FBG Capital. FBG has always been a digital assets focused hedge fund, and we started in 2015. We do trading as well as ICO investing, and we currently have about 80 companies in our portfolio. So the topic today about valuation is something we think about a lot.
And I'm Keith Tier. I run a $200 million venture fund out of the UK called ADV. I've been an advisor to a whole bunch of ICOs. Probably ones you've heard of would be ICO Box, Crypterium, and quite a few others. And I am doing an ICO for something called Venture Network, which is the first non-crypto fund venture play. You'll have to go and read about it at venturenetwork.io. Today we're going to talk about what is the value of a token is the title, which is kind of a generic title. Let's assume for the purposes of discussion tokens and coins is the same word used in different ways. And let's try, it sounds like there's some pretty basic questions for the audience in the last session. Let's start by just getting down to the roots of it. How can you even think about what the value is in a token? What are the criteria when Pantera invests or when you guys invest? What are you thinking about? And just jump in, I'm not going to pick you, so whoever wants to go first can jump in.
All right, I'll jump in. I think first and foremost, there's not a lot different from the concept of traditional diligence when it comes to looking at an opportunity. And I think a lot of people kind of shy away from the concept of looking over what the team looks like, the product itself, where are they in the general development schedule. So a lot of those ancillary questions that, in one way or another can't necessarily be answered should in one way or another be a red flag to you as you're looking at a token. But to that end, I think there's probably three major ways you might look at a token or some sort of ICO offering. And I think number one is generally the metrics as it relates to the value of the token. Where is it being distributed? What is the type of offering as it's related from pre-sale to full sale? So the question of circulation, volume of transaction. That's maybe one area. The second certainly would be the strategic relationships behind it. So often, I think we're looking for what kind of distribution channels do they have? Have they made a relationship with a number of exchanges? Are there lockup periods behind it? And I guess third is the obvious utility of it. What is the actual function of this? Can this be achieved outside of a token requirement? And so the small tea leaves that we look for perhaps in a white paper, for example, would be how much focus is there on the specific sale function as opposed to the actual product? And those are very straightforward indicators of the purpose behind, I think, an ICO. But at a very high level, I think there are a lot of challenges for us in assessing this, and this is a very new space to be assessing it to begin with. And there's a lot of, I think, vectors outside of what the value we might look at with those parameters that can be impacted. So, for example, Adam kind of alluded to this earlier. You can imagine Starbucks having, two versions of an Ethereum token out in the market. What happens when CryptoKitties, attacks, the bandwidth offering, and therefore ERC20 token might have a little bit more difficult time transacting over the network. So there's a lot of different areas there that I think do not apply from the traditional perspective.
Okay, anyone else want to disagree or agree or say something different?
So I have both an engineering and finance background. So I've been really thinking about, because when I went to the business school, like the finance professor, corporate finance professor, one of the major things that he was talking about was the value of a company is creating shareholder values, right? Maximizing the shareholder values. So what does that apply for tokens? So there's one headline news that really attracts my attention the last couple of days. The biggest ride-sharing company, Didi in China, they lost suddenly in 3 days. They lost 30% market share to another company called Meituan in Shanghai market. One of the reasons for that was once Didi already got the monopoly position in China after they kicked out Uber. So after that, they have been manipulating the price, basically trying to jack up the price for the riders without passing the value to the drivers. So that really makes me think about the whole thing. Because, for example, the modern shareholder system, the modern corporate structure started at the Industrial Revolution time. At that time, our economy is more like a manufacturer-driven economy. So at that time, in order to, there's a direct conflict between the labor force and the factory owners. In order to alleviate that, basically, the shareholder system was created, and they aligned the incentive of the shareholders and the investors, the owners, and the labor force. So with that interest alignment, we can say in order to maximize the company value, it's all about maximizing all the shareholders. But in a service economy like we're currently experiencing, I mean, a lot of times these folks basically we're dealing with information, dealing with marketplaces. For these companies, in order for them to maximize the entire ecosystem, because their stakeholders are no longer just the entrepreneurs, their employees, their investors. For example, in ride-sharing case, there's drivers and there's passengers as well. If you just want to maximize the value for the first three groups, I mean, you definitely will squeeze out the other two groups. So that's not the best way to maximize the entire ecosystem. So now I look at ICO as more a social economic change based on what's our current economic structure. So this is not just maximizing the value for a company, but it's more like optimizing the value, maximizing value for the entire ecosystem. So if you look at what's the underlying value for the token at the end of the day, it's how much activity, how much transactions you stimulate in your ecosystem. So that's how we look at value right now.
It's interesting. I'm a partly an economics major, and I'm old enough. I went to college in 1974 in England, and in England in 1974 you had to read Adam Smith and Karl Marx. We read both. Now, interestingly enough, they both agree on what value is. So the capitalist economist Adam Smith and Karl Marx both agree that value actually is the embodiment of human labor. That is to say, it's when we all work and we create either products or services and we get money, that money is the embodiment of the value we created. So a token has to somehow trace itself back to a body of activity, a body of effort, a body of work, and the value somehow has to be related to that. Do you see that happening? Give both some good stories maybe and some bad stories of what you're seeing in token economics. Pitches you see that you say no to, other ones you say yes to, and try to give the audience a sense of what the difference is.
Yeah, I mean, just to help, the way that we think about things, similar to Scott, I mean, does this token actually make sense within a certain ecosystem? Is it really going to be used? Is it the only sort of value that's going to be residing within the ecosystem versus making revenue any other way? And then I guess going past that, there's social sort of value that you've seen from, again, going out there, marketing, creating a lot of sort of investor, confidence, investor hype. And then, of course, the economic value of basically, are they actually having a product that is being used by users? Are they producing transactions within a certain ecosystem? Right now it's hard to do any sort of evaluation of that. You can take a look at the sort of the social metrics, but at the end of the day, the way that we do valuations is we look at the type of company, and the great thing is we've invested into quite a few companies, and we've seen a lot of companies, so we can actually segment whether it's at the infrastructure level, whether it's at the platform level, or whether it's at the application level, and then what segment within each of those a certain company falls within, and then we actually do comps, just like anybody else. And we do comps on private markets, we do comps on companies that are already out there, and we see sort of where they're valued at and where they could be valued at in the future. And then later on, determining whether to hold on to a position over time, then you start turning to a hedge fund, and then hopefully over time, you're able to analyze how these companies are doing based off of their sort of economic metrics. And we haven't really seen a lot of that yet. It is really just based off of speculation of what value these companies can and sort of create over time.
So Lucille, you're in digital asset management. Some would say hedge fund. Normally that is a pretty value-sensitive form of investing.
Yes. So something that's interesting about investing in the digital asset space is that there's a liquidity event that happens in a much shorter time frame than it would in the traditional economy. Once a token gets listed on an exchange, people can buy and sell and cash out and kind of do whatever they want. So in that sense, it can be easy, it can be simpler to sort of tie the value of the token to what the team is doing if you're keeping track of whether a team is hitting milestones, releasing updates when they promise to. But at the same time, a lot of these updates don't represent full implementations. It's still like a partial implementation or some kind of a like a test. So even in maybe the most concrete case where there's a valuation offered by the market, it's not necessarily, it's hard to say that that's the true value of the labor behind an effort.
Just out of interest, did any of you invest in the Telegram ICO so far? You don't have to disclose if you can't, but I'm going to guess some of you did. So I've heard stories there where I think it was 32 cents the first batch, 32 or 37, I forget, but it was like way less than $1. And what I've been seeing out there, and there was a lock-in for 12 months or 18 months, I think, for those people. And I've seen multiple sales where the people who bought at 32 cents, even though they were locked in, were able to sell pretty much straight away at 50 cents. And those people who bought the riots at 50 cents also sold at like 77 cents, all the way up to 137 cents, which was the second phase of the ICO. So you get the sense that...
But with no lockup requirement.
Yeah, they didn't do a whole lot of human labor to make that money, that's for sure. So what I'm sensing is that there's two separate things going on here. I'd love you guys to try to unravel them. One is a profound long-term shift in where value is stored. And the second is a short-term flipping mentality to make money quick. Now, obviously everyone wants to make money. I'm not saying there's anything wrong with the short-term view. But how do you think about the short-term and the long-term? I mean, what would get you to buy a token and hold it for 18 months versus what would make you never do that and want to flip? Maybe that's a good question. It's kind of a personal question, so I'm assuming you're speaking on your own behalf, not on your firm's behalf, but how do you think about those things? Anyone?
Maybe I could throw out Kick versus Civic and the mindset behind that. So we did not invest in the Civic, or excuse me, the Kick ICO. The point is from what we see in the traditional market trends as it relates to a messaging service and the convergence towards a payment peer-to-peer function that we've seen in Alipay, Baidu, et cetera, elsewhere, where peer-to-peer payments on the messaging app seem to be kind of where most folks are headed. So there the thesis is just generally market trend. Kick makes sense. We think there's a long-term value there. I can understand the utility of having some sort of information tailored with that. I know there's challenges at SKU level when it comes to traditional payments. So a lot of interesting things can come from that, and therefore there's a long tail as it relates to it. You contrast that to something like Civic, where there was a product in market. It was a very simple product. It was coming from a founder that we had worked with in the past. We'd seen exit to First Data. He was addressing the significant issue of GIFT, GYFT, this is Vinnie Lingham, of course, fraud as it relates to your credit card and swapping on the gift card platform that he sold. And so we knew this was a dear challenge for him because he's experienced it firsthand. And secondly, we felt like the method for which they were rolling out the process, effectively referencing onboarding solutions across all of onboarding and housing that locally on your device, that seemed like a very unique offering. So for us, it was more moonshot, right? And I think, the two caveats with that is number one, Kick's been around for a while, has a significant user base, simply pivoting into this, leveraging the utility of the utility token, versus say, Vinny and Civic, which has a significant promise, a very brand new way of looking at identity, how it might work on the device level. So those two things paired, I think, are very different from, say, a green entrepreneur that is working on a boiling the ocean challenge, a complete full infrastructure play. They're going to do mobile banking, they're going to do an exchange. I mean, there's a lot of indicators from the tried and true entrepreneur building a product and then leveraging something like a token versus those that I think are jumping on the bandwagon. So I don't know if that answers your question, but it's very important for us to understand the purposes and intent behind how the pre-sale functions. And NVIDIA in this case, he was very public and very democratized as it relates to the sale. And I think that was a very important caveat there compared to
Okay, anyone else?
Yeah, so this is probably a little more personally though. I'll start off with the funds thesis. The funds thesis is to buy into sales and companies that we think are going to be disruptive over a decade. You know, it's going to take a long time to make these disruptions, whether it's at the infrastructure level or whether it's at the application level. I think the reasons to sell sometimes are going to be, you know, portfolio management, right? I mean, I think there's things that happen where you need to balance your portfolio. I think in terms of how I look at things, if it is something like a kick where there's an existing product and the token fits in with an existing product and can be used right away, you can kind of already see how the token's going to be doing right off the bat. It's more of a, I guess, quote unquote, like centralized system right off the bat where you don't necessarily need companies and applications to be building on top of it to see the use of the token, versus if we're investing into something that's going to be competing with Ethereum, that technology, to get that right and to not only get it scalable and also secure, is going to take a little bit more time. And not only do you have to get that technology and product built, but you actually have to have companies building on top of it and actually using those functions, like, you know, a new smart contract language, you know, governance, etc. So that's going to take more, you know, 2 to 3 years, you know, or something like a, you know, a Filecoin or something where, you know, it's the technology is completely new and you have to build an ecosystem around it and people to contribute resources before you can actually have applications being built on top of it. So it really depends on the type of company and where it fits into the stack. But nevertheless, I mean, for the most part, we are long-term holders.
Let's move along and just slightly change the question. So the SEC obviously thinks that all tokens are securities, or at least, quote, I've never seen one that isn't, unquote. The Swiss government, on the other hand, recently gave a declaration that it sees 4 different kinds of tokens in the market. It said payment tokens, utility tokens, security tokens, and hybrids that have elements of 2 or 3 of those in them. I'm seeing a trend towards asset-backed tokens. That is to say, somebody says, let's say the 49ers said we're going to issue the 49er coin for 10 years worth of tickets in the stadium. And the only way you can buy these tickets now is to use the coin. And it's a way of accelerating revenue from 10 years into the present and getting a bunch of cash in the bank today. How do you think about the different types of tokens, ignoring the SEC, which I think will eventually change its mind? Let's not get down there. How do you think of value as it applies to different types of tokens? Anyone? Lucille, I'm going to force you to go next because you haven't had time to think about it, which means you're going to say what you really think.
You know, I think this is a tough question to answer because I don't think there's really a bright line distinction between the different types of tokens, whether they're, in most cases, whether they're securities or utilities or asset-backed or whatever. And
so in other words, for you, that's not the criteria. There's other criteria you're looking at.
no, currently whether a token is a security or not is not a key criteria. It's
Do you care about the domicile? Like, let's say it's a US company versus, let's say, a British Virgin Islands company. Talk about that.
Yes. So typically we invest only in companies domiciled out of Singapore or Switzerland or governments with a more experimental position on cryptocurrencies. But right now our focus really is more on the underlying technology as well as the upside and the strength of the community. In terms of how we think about how regulatory bodies are trying to impose frameworks on cryptocurrency, we're really taking more of a flexible wait and see position. My personal opinion is that I doubt any government is really anti-technology, and I doubt any governing body would try to really slow the pace of their fintech development down, but there are a lot of other issues that governments have to legislate around, like protecting retail investors who don't really know what they're putting money into, and capital flight and other things like that.
There's a great history of the competition between city-states and emerging nations centuries ago, where wars were fought over which currency was going to be used. So you can never assume governments will be nice.
Yeah, actually, it's funny that since everything is called cryptocurrencies, right? One of the question is, do you think they are real currencies instead of securities, right? But the answer is obviously no. I mean, just like the poll we did like in the previous session, only 2 people out of the entire crowd is actually using Bitcoin as a payment. So at the end of the day, like these so-called cryptocurrencies either becoming a digital gold or a new form of, I would say, socio-economic representations. I mean, they're probably not the securities that we're talking about today, but it's the beginning of something completely new. And last time when this happens is like 200 years ago when the stock market was created. So, I mean, if we talk about valuation, right now most of the valuation is built on expectations. Expecting these things will grow significantly in the future. And all the comps are based on that as well. And when the market expands or contracts, I mean, the comps will change as well. So, but I mean, the reason for people to put so much hype behind it is that it definitely represents something very significant in our society. So, although right now we don't have a clear formula other than comps to talk about values, but I mean, I believe intrinsically there are values involved. It just takes time for people to build, like people build modern financial theory based on like maximizing shareholder value. There are similar ways you need to build value system for tokens as well. It just takes time and more academic research on this.
A lot of the audience questions are asking us to talk about the value of tokens beyond the general interest in decentralization. Just to put tokens in the context of history a little bit, and being British kind of helps here. The pound used to be the global reserve currency between the wars, before the wars. Then, the British Empire faded, and the rise of both Germany and America originally led to 2 world wars while they figured out who the winner was, and eventually the dollar as the reserve currency. Today, the dollar is weakening. China is clearly going to be, with India, the leader of the world at some point, but the Chinese currency probably isn't going to become the reserve currency anytime soon, because that usually never happens. Even the dollar could become the reserve currency very quickly without 2 world wars happening. So gold usually is what the world turns to when national currencies fail them. Is it possible that digital plays a role of a reserve currency between nations? Is that, there's a store of value, is that enough for crypto to be valuable? Or does it have to become a means of exchange where we actually buy cars and houses with it?
Well, I mean, just 40,000-foot view of what ICOs represent. I mean, number one, to the startup, I can choose the time, location, how much I'm raising from anyone in the world. That's a big difference from what it was 10, 15 years ago. You can imagine how many times they paraded down Sand Hill, knocked on doors, met the wrong person, wasn't there, so for whatever reason the thing didn't work out, didn't get the deck sent over, wrong email. A lot of different ways that these challenges occurred, so the value of having the ability to raise money from anywhere is pretty significant, particularly on the timing of their needs. Secondly, it creates a very interesting engagement model for your consumer base, right? So you have a direct line now, hypothetically, to a consumer that might be using your product over time. And then third, to the investor, you can imagine, I mean, outside of the lockout periods, what kind of risks now I can look at. I have liquidity, so I have the ability then to move quicker or slower as it may relate to something like this. So fundamentally, this is a pretty significant shift in the value proposition to the process of creating a company and the capital behind it. And I think the reason why this is real is because folks like NASDAQ, New York Stock Exchange, major exchanges around the world began projects like these 4 or 5 years ago, understanding the implications of having a direct line, an ICO, to a market. What is their value prop now? And I think it's a very similar concept of going upstream. If your water is cut from you upstream, you're not going to get anything to your farm if you're 3 farms down the road. So,
we've only got like 3 minutes left. Does anybody want to ask a question so that you can, the floor can speak? Anybody? Hands up. I can't see. No? Yes? I think the answer is no, so we'll keep going. So what are you going to invest in next?
Invest next? Actually, I'm working on a project.
Come on, tell us. We all want to buy some of it.
So, yeah. So if I invest, I will invest my own project. Yeah.
Anyone? What are you looking for? What do you want to walk through the door and present to you?
Yeah, I'm gonna invest in his project actually. You know, we're similar to FPG. I mean, we are, you know, especially when markets are down like this. I mean, you know, it makes sense for us to continue to search for longer term projects. That means that we've come across a few different projects, either trying to compete with Ethereum or trying to compete with Bitcoin. Ethereum in terms of a new smart contract language, being able to maybe even have privacy and maybe have better throughput. And then of course maybe some other solutions to try to help scale those different blockchains a little bit more on the equity side. We're continuing to look at applications. We invested in quite a few applications already, and for us applications mean things where we think make a lot of sense for decentralization, whether it's helping to accelerate or expand markets. So focusing on heavily regulated industries or marketplaces that have incumbents that are taking, you know, very high fees. Something else that I'm really interested into, and I think we're going to make a couple of investments pretty soon in, are, like you mentioned, security tokens, asset-backed tokens. We actually think that that could be even much larger than utility tokens. Utility tokens are fun, and personally I like investing in utility tokens because it is like gambling. But nevertheless, looking at security tokens, they are evaluating them very similar to venture investments, and the reason why we're excited about them is the fact that you can actually bring a liquidity to very illiquid markets and actually open up new investment classes. So things around like tokenizing.
Let's stop there.
Yeah.
Because we've only got like 1 minute left, and Lucille wants to say something.
Actually, all of Paul's points were great, and we're like FPG's looking closely into quite a few of those segments as well. Me personally, I would be interested in a very easy to use wallet where users don't need to worry about their private keys, don't need to, you know, like go online, type something in, use a hardware wallet. I think that is a key bottleneck to maybe having broader cryptocurrency adoption, and that would also be an application that a lot of protocols would be interested in having building on top of their platform.
Okay, we've got to wrap. If you are interested in asset-backed tokens that address the problem of liquidity, venturenetwork.io, go take a look. Thank you to all of you. The great panel, great audience, thank you, and we'll move along.
Thank you.
Thank you guys, that was great. Thank you, Keith. And next we will be having a panel discussion on trading or investing.